So, you're living in New Jersey or New York. The winters seem to be getting a bit colder, the commute to work a bit longer, and the burden of having to pay high state income taxes is beginning to wear on you and your long-term plans. Is it time to move to another state where the weather is warmer year-round and the state taxes are much lower, or maybe even non-existent? Before you pack your bags and schedule the moving van, it's critical that you understand how to cut the cord with your current state, so that for state tax purposes, you're no longer considered a resident of the state that you're leaving. Before I provide an illustration of what's often referred to as a change in residence, it's important to define the term domicile and talk about the distinction between this term and residence. The term domicile means the place where the taxpayer has his or her true, fixed, permanent home. It's the place to which you intend to return whenever you've been away. It's extremely important to note that while a taxpayer may have several residences, he or she can only have one domicile. Moving to a new state doesn't change your domicile if you intend to return to your original domicile. In fact, while the length of time customarily spent at each location is very important, it's not necessarily conclusive in establishing domicile. Due to the great importance of domicile for state income tax purposes, you must be able to prove with clear and convincing evidence that such changes have occurred. Let's assume we have a taxpayer living in New York and wanting to change their domicile to Florida. With no resident income or estate taxes currently, the Sunshine State can offer some significant tax advantages and savings, provided you've planned properly. Part of this planning includes understanding that New York is motivated to keep taxing you as a resident and will likely conduct an audit on the tax year for which you cease filing as a resident. As a taxpayer, it's your job and responsibility to prove that you've cut the cord with New York. There are essentially 5 primary factors that a New York auditor will use to determine domicile. These are your home, active business involvement, time, items near and dear, and family connection. Number 1, your home. It's commonplace for a high net worth taxpayer to own multiple homes. The number, size, and value of the homes, together with the nature of their use, are all considered in this analysis. The second factor is active business involvement. The questions of how and where does the taxpayer generate income are in play here. These are key factors when determining if a taxpayer has established business ties in Florida and/or has broken business ties with New York. The third primary factor is time. The number of days you've spent in Florida versus those you've spent in New York will be highly scrutinized, along with the taxpayer's living patterns and duration of visits. Taxpayers who continue to spend significant amounts of time in their former New York home will put themselves at great risk. In fact, the burden of proof rests squarely on the taxpayer to prove they haven't spent more than 183 days in New York in a given year. Otherwise, the taxpayer will run afoul of something New York calls the statutory residence rule. Number 4, items near and dear. There's a saying that home is where the heart is. This applies for tax purposes as well. Transporting personal items near and dear to you from New York to Florida is viewed as a critical factor in establishing a new domicile. Examples can include pets, artwork, collections, and other personal effects. The fifth and final primary factor is family connection. Where is the taxpayer's family located? New York is primarily concerned with the taxpayer's immediate family, the spouse and minor children. While this factor is more limited than the other 4, it's still a primary factor in establishing domicile. Ideally, analysis of the primary factors will produce clear and convincing evidence that a change of domicile has occurred. But what happens when this evidence still seems to point equally to domicile in New York and Florida? In this case, a New York auditor will turn to other or secondary factors that may serve as tiebreakers. Subordinate to primary factors by their very nature, auditors are cautioned to be aware of the ease of control a taxpayer may exercise over these measures. A list of some of these secondary factors appears at the end of this video. In summary, changing your domicile from one state to another may provide significant tax advantages, but a taxpayer must be prepared to make comprehensive changes to their lifestyle, which includes spending significant time in the new state, restricting both business and social contacts in the old state, and diligently maintaining detailed records to support the change in domicile. If you'd like to know more about this topic, please give us a call or reach us through our website. We'd welcome the opportunity to share our experience and knowledge with you in greater detail. I'm Paula Lampe with Untracked Early.